Whether you buy, sell, mine, or receive cryptocurrency as payment for goods and services, each disposal will result in a capital transaction that must be reported on your tax return. The value you report will be based on your cost basis, which is the price at which you acquired the digital asset. Taxes on gain. The IRS considers crypto assets to be property rather than currency, which means that when you sell cryptocurrencies, you're paying taxes based on their fair market value at the time of sale, just like when you sell stocks. Gains and losses from cryptocurrency sales are reported on Schedule D, along with other gains and losses such as capital gains and losses from other investments, including real estate and mutual funds, and the proceeds of any tax-deductible gifts or inheritances. When you sell a cryptocurrency, your taxable gain is the difference between the sale price and your cost basis in that coin or token, which is typically its fair market value in USD at the time of purchase, plus any fees associated with the transaction. Generally speaking, short-term gains are taxed at ordinary income rates, while long-term gains are taxed at lower capital gains rates. In some cases, the IRS may treat your crypto as earned income instead of a capital asset, such as when you receive it in exchange for services or as compensation for your labor. Crypto as earned income is taxed at the fair market value on the date of receipt, which can vary based on how the transaction was structured and whether you receive a 1099 form reporting the payment to you. Keeping records of every cryptocurrency transaction is critical, regardless of whether it's a sale or a gift. You'll need the transaction details, including the amount and parties involved, as well as your coin or token's current fair market value and the cost basis at the time of purchase. You can calculate your own cost basis using software, or you can use a service such as Coinly to keep track of all your crypto transactions and automatically populate reports for each tax year. In either case, it's important to keep your records for at least 6 years to cover any potential audits by the IRS. Taxes on losses. When you sell your crypto investments at a loss, the IRS treats them as capital losses, which are taxed the same as any other capital gains. The amount of your capital losses is equal to the selling price minus your cost basis, and can be used to offset other gains or reduce your overall tax liability. If you have no gains to offset, your losses can be carried over to future years to reduce your tax burden even more. One common way people realize a loss is by trading their crypto for fiat currency or other assets, but this is also a taxable event. In the case of crypto, the exchanges that handle these transactions typically charge a transfer fee in the same currency as the asset being traded. These fees must be included in your total proceeds when reporting a trade, and you must determine the fair market value of the asset at the time of sale to calculate the gain or loss. The IRS requires you to report any gains or losses from crypto transactions on Form 8949, which includes information such as the date of acquisition, the date sold, the total proceeds, and your cost basis. You must also report the tax status of the transaction, either short-term or long-term, depending on how long you held the crypto before selling it. It's important to keep detailed records of your crypto transactions, including all costs and the fair market value of each coin at the time of purchase, as well as the sale and disposal prices for each cryptocurrency. It's also helpful to document any activities related to your crypto, such as mining, staking, and exchange activity. The IRS uses blockchain analytics to track the movements of digital wallets and tie them to individuals in cases where they suspect tax evasion or money laundering. It has also won cases against major exchanges such as Coinbase, Kraken, and Poloniex, forcing them to share customer data. In addition, many exchanges have records of the addresses from which users withdraw funds, helping the IRS identify custodial wallets too. Taxes on transfers. If you've been trading crypto, it's important to keep track of all of your transactions. This is because the IRS views most crypto events as taxable, including cashing out, selling, and using crypto to pay for something. For example, swapping one coin for another, or even a stable coin like USDC, is a taxable event because you are essentially selling the first coin to purchase the second one. The same is true for using crypto to buy physical goods, services, or NFTs. If you're an active trader, you may have thousands of buys and sells per year, which can make calculating capital gains and losses difficult. A reliable cryptocurrency tax software can help simplify the process. While many people think of crypto as currency, the IRS views it more like property. As such, any gains on crypto will be taxed as capital gains. These are typically reported on Schedule D and Form 8949. There are some cases, however, when your gains will be taxed as income instead of capital gains. This includes when you receive crypto as payment, airdrops, and earning coins or tokens in play-to-earn games. When you sell your crypto, you'll need to determine the fair market value in USD on the date of sale. This is called your cost basis. Subtract the sale price from the cost basis to find your gain or loss. If you have a loss, it can be used to offset future gains or up to $3,000 of your taxable income per year. The IRS is starting to require all cryptocurrency exchanges and wallets to report the amount of money you have in each coin. As a result, there is an increased chance that you'll be audited. This is why it's best to work with a licensed tax professional. They can help you avoid mistakes and save time by preparing your return accurately. In addition, working with a tax professional can also reduce your risk of an IRS penalty or interest charge. Taxes on mining. If you're mining crypto as part of your investment strategy, you must pay taxes on your profits. This is because the IRS treats cryptocurrency as property, and property transactions are taxable. The same rules apply for mining as for buying and selling crypto. You must report mining earnings as income, and you'll need to track your mining activity so that you can report it accurately. The IRS also considers any activity that uses crypto to buy goods or services a taxable event. For example, if you're paying a home improvement contractor in Bitcoin, this is taxable income. Similarly, spending crypto to purchase physical goods or services like restaurant vouchers is taxable. Finally, using crypto to pay fees for services like exchanges and staking is taxable. As with investing in stocks, the IRS requires that you keep records of your crypto investments to report on your tax return. Whether you use CoinLedger or another tax software tool, you'll need to record every crypto transaction for the year and compile it into a file that you can upload to your return. You'll need to include the description of each asset, such as Bitcoin, the date it was acquired, and the cost basis. You'll also need the date of sale or exchange and the proceeds from the transaction. The good news is that the length of time you hold your crypto can greatly reduce your taxes. If you sell crypto that you've held for less than a year, the gains are subject to regular income tax rates of up to 37%. On the other hand, if you HODL for more than a year, your gains are taxed at lower capital gains rates. Cryptocurrency taxes can be complicated, but it's important to report your transactions accurately. By keeping detailed records of your crypto investment activity, you'll be able to avoid penalties and maximize your savings. If you're interested in learning more about crypto taxes or filing your tax returns, Jackson Hewitt can help. Our local tax pros are up to speed on the latest crypto laws and can make filing your taxes fast and easy. Contact a local tax pro near you today to get started.